Get Rich Education is brought to you by Norada Real Estate and International Coffee Farms.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Hey, welcome to GRE, Get Rich Education, episode 69. I'm your host, Keith Weinhold, back to help you build durable wealth for yourself. Today, we're going to talk with Kathy Fettke, a woman with a great wherewithal for what's happening in the economy. She knows how to invest in the best cash-flowing real estate in markets with sustainable economic drivers, and she's had a great long-time media presence. Here's hoping that you've lived an abundant week. I have lived an abundant week, pretty much, outside of having some knee surgery. I'm kind of hobbling around here. But the week prior to this one, there was a magnitude 7.1 earthquake that we felt here in Anchorage, Alaska. And you know, that got me thinking about real estate in a different light. Now, here in our home, we had some art slide off the walls, some knickknacks fall and break, pretty minor damage, but the greatest damage was probably to my wife and I's peace of mind. It felt like the home was shaking for more than one long minute, and then shortly after, I know it's over and that we're okay, then I start thinking about the fact that, geez, outside of my own home, I own nearly $2 million worth of rental buildings in this local market. And unlike with some other calamities, earthquake insurance is prohibitively expensive to buy. Okay. I don't have an earthquake policy for that reason, and few do. It's just really one of those things to keep in mind when you're buying real estate. And now, fortunately, in the United States, the best cash flowing real estate markets, since they are typically in the Midwest and South, you've got less seismic activity there. So, in a sense, you're kind of hedged that way. And gosh, it's just another nail in the coffin for real estate investing in coastal California, okay? And hey, nothing wrong with coastal California. I love visiting there. I've done the show from there. Today's guest even lives there. But it's about the last place that you look if you want financial freedom from cash flowing passive real estate investing. One near tragedy with our Anchorage home being rattled in the earthquake is that inside our walk-in pantry, a bottle of A1 steak sauce fell from a shelf down onto the floor. Thank God it didn't break. A1 steak sauce is perhaps the most important condiment in the home. Thank goodness that atrocity was averted. Okay, if you don't have A1 steak sauce in the home, I don't even know if that's a home. It's merely a house. Yes, that's how important A1 steak sauce is. That and Frank's Red Hot sauce, okay? Those foods turn houses into homes. There's got to be a viable supply in the pantry at all times. So, hey, I need to find a little light in the subject of an earthquake rattling not just our home, but our nerves, okay? So, home equity has less safety, less liquidity, and a lower rate of return than a bank account. Home equity is a giant fail as an investment, as I've discussed on the show many times, and excess property equity is also exposed to calamity risk. If a home were a total loss in an earthquake, that's tragedy no matter what. But you're going to feel the sting harder if you had all of your equity exposed in the market too. It goes away like poof in the event of a calamity, okay? So consider keeping your loan balance high and put that risk on the bank rather than yourself, like I've discussed so often. Hey, and something kind of funny about the earthquake too, a lot of friends posted their earthquake thoughts and photos on Facebook the day of the event. And I have a lot of local realtor friends. Well, you know what? None of those realtor friends made one social media peep about the earthquake, okay? They just don't want to stir that up because it's not good for their business. Who wants to think about buying property where there are earthquakes, all right? So just kind of funny, not a peep from them. Realtors are like, what earthquake? You felt something? So Everyone wanted to talk about the earthquake except for the realtors. So, all right, well, enough about rattled homes and nerves. Today's guests and I are going to discuss rattled markets, the demographics of this rental boom that we're squarely in here, and we're going to chat about more. So let's meet her now. Our next guest is an active real estate investor, licensed realtor, certified coach, and former mortgage broker. She specializes in helping people build multi-million-dollar real estate portfolios through creative finance and planning. She has a passion for researching and sharing the most important facts on real estate and economics. She's a frequent guest expert where you've seen her on your television on CNN, CNBC, Fox News, NPR, and the Wall Street Journal. She is the author of the #1 bestseller, Retire Rich with Rentals, and is host of The Real Wealth Show. Welcome to Get Rich Education, Kathy Fettke.
Thank you.
Yeah, Kathy, well, we have an awful lot going on in the economy right now. We always do, but, if you think of different sectors of the economy as certain pistons that are maybe pushed up and pushed down, right now we have oil at multi-year lows. We have home ownership rates at generational lows. We have the Fed hiking rates, even though the economy isn't quite booming. So, we really have a pretty interesting dynamic now.
Well, do you want the truth or do you want to be a little depressed?
We want the truth, and sometimes the truth is depressing.
I guess it's the same thing, right? Well, there's been a lot of cover up, I think, from the government and what's really happening. I mean, even Obama's State of the Union address last week stated some things that just weren't quite accurate. One of them being that, the number of jobs that were created wasn't quite accurate and so forth. So what we do know is that the recession that we had in 2008 was so enormous. It was such a huge loss that the only way the government knew how to fix that was by borrowing money. And we did that through many different forms, but the biggest, of course, we know is quantitative easing, which is something that's never been tried before, not in our country, not to this level. And the solution was to pour 4.5 trillion, and some say more, into the economy to stimulate it. And at the time we had Helicopter Ben Bernanke as the chairman of the Fed, and he's known as Helicopter Ben because his comment was, hey, to stimulate an economy, I'll go as far as flying a helicopter and dumping money out of it if that's going to get people to spend.
And he basically did that.
And so what we have is really fake prosperity. And it's amazing to me how many people think it's real. And as long as they think it's real, they're going to get hammered. And if you really pay attention and trust your gut, you'll know something's wrong. I mean, it's the same thing in 2006. I think you could look back now, and most people could look back and say, oh, that was pretty obvious what was going on there. We were basically giving people free money to buy houses. When you give people free money to buy houses, and in some cases money back. I mean, there were loans, I don't know if you remember, but you could get a 105% loan.
Yes.
Yeah, so you could buy a house with 100% financing, no money down, but you could even get 105% financing, so you could get like 5,000 or 5% back to pay for stuff. Crazy.
And maybe only state your income, just state it.
Yeah, you could get all that just by filling out an application that no one checks, right? So being a mortgage broker at the time, it was really obvious to me that there was a problem. And I have to say, everybody loves pointing fingers, but borrowers had to know something wasn't quite right. Like, why are they giving me this loan? It just doesn't make sense. So I think we've forgotten to trust our gut and to look at common sense and to say, would this work? So in this case, we had a major recession from a problem of borrowing money, and we fixed that problem by borrowing more money. So there's a problem, right?
Yeah, that's right. In fact, whenever you talk to a macroeconomist or a global economist, you really never hear anything other than gloom. They never have positive things to say. They're talking about all the structural problems that we have in the economy that have really never been fleshed out. There really isn't any one macroeconomist that I know of that thinks everything's going to be great.
Yeah, well, but there's a lot of people who, and even big time investors who don't see the problem. And that's really what's shocking. I was kind of out and about last week asking people how they were doing, wondering if they'd gotten slaughtered from the stock market losses. And I kept hearing the same thing. It was like a drone. It was like a robot that had been programmed to think a certain way. And it was simply, oh, that's the way it goes. Markets go up and down. It'll go back up. You just keep it in there for the long term, blah, blah, blah. Everything that people have been brainwashed to believe about their money. And so there's just this denial out there. And it's the same denial that we experienced in the 2000s when we were creating a massive bubble then. So this is the best way to describe it. I don't know if you've ever experienced a time when you got access to a whole bunch of money and like credit cards. And when I was in my 20s, I remember getting my first credit card and I felt rich. I really did. It was like, oh my gosh, I have all this money. And then when I was in my 30s, we bought a house and I'd go to the bank and I'd go to make a deposit and the teller would say, hey, would you like an equity line? We can give that to you today. And lo and behold, they'd give me an equity line that was more than I made in a year's time, and so once again, wow, I feel rich. Come home, tell your honey, we can get a new kitchen. It's this feeling of prosperity and people forget it's borrowed money. So it's not real. At some point you have to pay the piper. And so that's kind of where we're at right now is we keep borrowing in an unprecedented way. No country's ever tried this quite the way the US has. And the only other country that's kind of tried it and failed miserably is Japan. So Japan had a major credit crisis 2 decades ago, and they've never come out. The market never recovered, and the housing market never recovered. It's been a 2-decade recession, and they keep doing quantitative easing, trying to fix it, but it's not getting fixed because they haven't dealt with the underlying issue. So, that's kind of where we're headed.
So rather than us dealing with our underlying issue ourselves, what we did to pull out of the recession was have 3 cycles of quantitative easing where we printed trillions to try to lubricate the economy and kind of stimulate what we're talking about here, which is the wealth effect, making people feel like they have a lot of money, like they have a lot of wealth, so that they'll spend and so that they'll make new investment. And, a lot of that money that was pumped into the economy, people predicted that that was going to cause inflation and a lot of structural economic problems with that inflation. But instead, sort of the opposite thing has happened, at least here in the intermediate term, where a lot of that quantitative easing money that was printed still hasn't come off the bank's balance sheets, and at least on a CPI basis. And I don't think we completely want to believe a CPI basis, but inflation's been relatively tame.
That's right. And so when I say we haven't dealt with the fundamental issues, what am I referring to? And, what does all this mean? And what does it mean to you and investors and real estate and all that? So we'll definitely get to that. But I first want to kind of shake people up and give them a reality check so that they can plan and prepare. At the end of the day, there's ways to make money in any market cycle. You just have to know it's coming before it hits you in the head, All you have to do is go back and try to remember what you were doing in 2006. And I'm guessing most listeners of your podcast were in that prosperity mode, that we had access to so much credit, we were spending, we felt prosperous. And if anyone had come to us and told us what was coming, we either wouldn't have listened and thought they were crazy, or if we had listened, we would have made different choices. So that's all. I want people to feel like they're back in 2006. If I'm wrong, fine, no big deal. But if I'm right, you'll be prepared. You will have made better decisions. So, and I kind of wish someone had told me that. I wouldn't have bought 3 properties in Boise, Idaho.
Well, we could be at 2006, just 10 years later here, teetering right on the precipice of potentially a recession. What are some reasons that you think that we might be up against the recession? I've seen you state previously that you think that one's coming. What are some of the factors that go into that?
Well, we have to really look at fundamentals. And one thing we know is that the US is dependent on us spending money. The entire economy is based on us spending money. That's why no matter where you go, whatever you do, you're being asked to spend money. And when 70 to 80% of our economy is based on that, we don't really produce anything anymore. We just spend. So what happens when we can't do that anymore? What happens to our economy? So when we look now at where we are, we need to look at who have been the big spenders. Who's out there buying stuff? We know that the baby boomers are and have been the largest generation in the US they're in their 50s, 60s now. So for 50 to 60 years, this massive generation, which a lot of people call the elephant in the python, just this
Right.
huge movement of people, they have driven the economy for years. When they were teenagers, whatever they were doing or buying as teenagers, that bubbled. Then as they went to college costs increased because there were so many of them. Then when they got into their 30s, when it's time to buy homes, well, the housing boom started. And then when they needed to start investing, well, guess what? The stock market boomed. Everything they do and everything they touch booms. And so here we are now with this huge population that's driven the economy for, 40 to 50 years. Something major is changing. And it's kind of depressing because I'm one of them. We're getting old.
Those people have left their peak spending years. I think that's what you're saying. That's starting to phase out for the boomers.
We are at retirement age, and 10,000 baby boomers are retiring every day. So you've got every day, can you imagine that? You've got millions of people retiring that are no longer spending because they're doing what? They're saving, they're retiring, or they're trying to retire. The largest population among the baby boomers is 54. So these 54-year-olds are now empty nesters, hopefully, and their kids are, gone, and they're like, oh my gosh, I've got 10 years to figure out my retirement. So they're not buying, their kids are gone, their kids are out of college, they are now in savings mode. And then you've got the older baby boomers who are retiring. And like I said, 10,000 a day. What do you do when you retire? You take money out of the stock market. You're not putting it in. You're taking it out because you're living on it. So to think that the stock market is going to continue in its bull run when you have this huge population that's not only not spending, so those companies are going to feel the effect and they're going to contract, but you've also got the people pulling money out of the stock market. So it's time to face reality.
Yeah, so you have that set of behaviors on the older end of the spectrum with the baby boomers. And then on the younger end of the age cohort spectrum, you have the millennials that here at right around this time are surpassing baby boomers in the number. There are now more millennials than there are baby boomers.
Correct. Yeah. As of 2015, the baby boomers' kids, which are ages 18 to, I think it's 34, it's kind of varied depending on who you listen to. That's correct. They became the largest generation, and they also are the largest group that is of immigration. So that generation is actually going to continue to grow. And they're forming households. So, that's good news. And that's the difference. That's kind of a saving grace that we have here in the US that Japan doesn't have.
Right.
And that's part of the reason they haven't recovered is they don't have that younger generation. Europe doesn't either. They've had a problem making babies for a while. When, I have a friend who lives in Europe, she married a French guy, and there was so much effort and marketing trying to get people to have babies because they knew they had this dearth of young people. My friend literally had all of her in vitro paid for by the government, all of the hospital bills, even food and diapers and childcare, all paid for by the government because there was so much push to have children, but it didn't work. So they don't have that younger generation to kind of pick things up and stimulate the economy, but we do. That's why everybody's focusing on the millennials because they will be our future, but they're not here yet making a huge difference right now. They're trying to get work. They're saddled with student loan debt. They're not going to be investing in the stock market. They're not going to take the place of these 10,000 baby boomers retiring every day. You're not going to see 10,000 millennials every day investing in the stock market to take their place. You're not going to see that many millennials spending the way that baby boomers had because the baby boomers are the wealthiest generation. They had the money to spend, but now they're saving it. So it's going to be a while before these millennials get up on their feet and start making an impact on the economy. And it's probably, from what most economists are seeing, it's probably going to be around 10 years. It's definitely 10 years before they start buying homes, not start, but before the majority of them buy. When they're in their peak home buying years in the 30s, we'll see a huge housing boom then. But until then, they're going to be renting. And that's important to know. And that's one of my little tips for your listeners is there's going to be a huge demand for rental housing. The millennials are going to be driving the economy. So now we got to pay attention to what they're doing and where they're spending money. Just look at what they did to college costs. You had this huge millennial population going through college at the same time. The largest group within the millennials is age 22 to 24. So they've just graduated from college or still just about to. And look at the way that university costs have gone up. It's because you had so many kids. Now, those college costs are going to go down because there's less kids. So watch for that. If you've got young kids, I don't think you have to worry too much. I think college is going to be cheaper later. But what are these kids going to be spending money on? You know what? They're going to be renting. So we're going to have a rental boom and we're going to see rents go up because they're not ready to buy. And so we can rent to them. We can succeed as landlords over the next 10 years. And in 10 years, when those kids are ready to buy, well, guess what? There's going to be a housing boom and the properties we've been renting to them will go up in price. That's my prediction. So that's the good news.
Right. So we will have been able to hold them for cash flow during all this time when there's sustained demand. And then later when they're ready to buy, that age cohort 18 to 34 will hopefully be buying and cause some appreciation. And yeah, it's those millennials. Yeah, I consider them age 18 to 34 as well. They're choosing societally to start families later. And that means they typically choose to rent in the meantime. And they are saddled with that student loan debt. As education costs have exceeded the rate of inflation, that usually means that they cannot come up with a down payment for a home and that they're going to be a renter. And, millennials often don't get a good job right away. When you don't get a good job, that means you don't feel attached and anchored to a certain geography. And again, you're more likely to rent than buy when that happens. And, another thing with millennials too, a lot of millennials, they saw their own parents lose their home. Mm-hmm. So they associate home ownership with foreclosure, short selling, and hardship. So that makes them a bit more reluctant to go ahead and buy a home for that reason too.
Yeah, they're just kind of not buying the belief that homeownership is going to make you wealthy. They didn't really see that happen.
Right.
If and when they learn the fundamentals of how to do it right, they'll jump in. And we're kind of seeing that. Like this millennial generation is pretty brilliant. They're young people that have grown up on technology. They have access to information at their fingertips. They always have. So, they're going to do well in life. They're not going to make stupid decisions. And so I think at some point, they're going to see the value of home ownership. But a lot of them are still choosing to rent because they want to be in certain areas. And like you said, they're in transition and so forth. But we're starting to see a bit of a trend of them buying investment property, but still renting their primary, which is interesting. It's something we've preached for a while at Real Wealth Network is, hey, live where you want, rent. I live in Malibu. We rented here for 5 years because it made more sense than owning. But we have rentals all over the country, where it makes more sense.
You and I are happy to rent to millennials for quite a while, I'm sure. You're listening to Get Rich Education. Our guest is the Real Wealth Network's Kathy Fettke. More when we come back. I'm your host, Keith Weinhold. Through Get Rich Education and International Coffee Farms, you can own your own half-acre parcels of a passive income-generating coffee farm in Panama for as little as $18,000. It's a low-risk opportunity with an average annual return projected at 12%. The farms are professionally managed for you on a turnkey basis, and you own the land. To learn more, visit internationalcoffeefarms.com.
Are you looking for a roadmap to financial freedom? If so, we have a solution for you. Norada Real Estate is offering a limited number of free strategy sessions to help you get out of the rat race. Learn how you can create wealth and build monthly passive income. To set up a time with one of our knowledgeable investment counselors, simply go to noradarealestate.com. That's NORADA realestate.com.
Hi, this is Russell Gray, co-host of the Real Estate Guys radio show, and you're listening to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education with our featured guest, Kathy Fettke. So, Kathy, you're predicting that there is going to be a stock market crash rather soon. Tell us about that.
Well, I think people are always shocked to hear anything about a stock market crash when in fact it happens in many, many different cycles and it repeats itself and usually every 10 years. And yet people still seem shocked about that. So I think one very famous investor, basically said stock markets don't have a soft landing. They crash. It's just how it works. And it seems to be because because of the denial and because we're usually in a place of prosperity right before the crash. So people just don't want to believe it. They don't want to see it. But let's look at the facts. So we know that the stock market is near all-time highs, just like certain real estate markets. They're at near all-time highs. So if you think that markets just continue to go up forever, then take a look at history. That's all I can say. So we know that the stock market's up 200% since its low in 2009. So that's a pretty strong rally. And we also know that in a rally like that, investors start to buy on margin. And when they buy on margin and stocks start to go down, they have no choice but to sell. They're forced to sell. They get margin calls, and that forces the market down further, accelerates the sell-off. So what happened on Friday where stocks went back up, that's fairly normal because people are still in that denial place. So they see a down market as an opportunity and they don't realize, hey, this is just the beginning of a long bear market. They see it as an opportunity. And that's what all my friends say who don't follow me or listen is when I asked them last week, oh my gosh, what are you going to do? They're like, oh, we're just going to wait for it to go back up. So it went back up, but please don't think for a minute it's going to stay there. Going back up is a wonderful opportunity to get out while you can. So just take that as a tip. So we know that there are some serious issues in the market, job growth being one of them. Everybody's been talking about job growth and how great it was, including Obama said he was so proud of the job growth. And yet when you really dive into the numbers, those jobs that he was bragging about that came in October, November, and December, because really 2015 was pretty sad, actually. It was much lower job growth than the prior year until the end of the year. And that was mostly low-paying service sector jobs. And when you dig in deeper, they went to women 55 and up, and then young people under the age of 24. So you kind of go, all right, what kind of jobs were these? Again, low-paying service sector jobs for the holidays. But in January, trust me, it's going to be a very, very different story because those people are going to get laid off. Retail sales were not good during the holidays. It was very disappointing. And so we're already seeing layoffs. And so, again, take advantage of the denial in the market because February, when January's numbers come out, there's going to be a reaction to that because everything's been based on all this new job growth, which isn't really real. Okay, and that's even why the Federal Reserve raised rates. They said it was job growth. Now, when they see that job growth is gone and now it's job losses, most likely the Fed is going to have to reverse its decision, return rates to near zero levels. They're going to blame it on oil or they're going to blame it on China. They're going to blame it on something. They're not going to blame it on the U.S. economy because they're going to keep trying to save face. But you need to really look at the details. And I've got a whole lot of this data on my blog, that might be easier for people to look into.
Yeah, low-paid jobs and part-time jobs are hardly enough to lead us out of a recession.
Right.
I didn't really think this economy can take 0.25% interest rate hikes, a number of them. I mean, previously, the Fed in the past, they only raised rates to help cool an overheated economy, but not when we're fighting off a recession. So it just doesn't seem to make sense to me.
Well, it doesn't make sense, but they had to do it because it's been this big illusion that they've been able somehow to carry off and pull off that everything's fine, but everything's not fine.
Yeah, it's a confidence play.
It's confident. They had to raise rates. If they didn't, then the secret would be out. Hey, why aren't they raising rates? Obviously, the economy's not good. So they raised them, but they raised them at a time when they could come up with some kind of excuse as to why they had to lower them again. So they're going to have that excuse with China. They're going to come up with something and say, oh, it wasn't anticipated and now rates are going back down. But expect that and expect another quantitative easing. Now, this is where things get a little tricky because our government has manipulated markets so much through this quantitative easing that they're going to do it again, most likely. They're going to try to prop up the economy during this election year with more money being poured into the market. They'll never be able to pour in enough or create enough money to save us from the problem, but they could make it look okay for a little bit longer, especially if the current administration wants Hillary in office. They don't want to have a massive failure. So it's possible that with a little bit more manipulation of the system, that things will be okay in 2016. But just know that they're not going to be okay for long, and it could be directly after the election that things collapse. So just know that. It's really, really hard to predict these things. But it's the same thing. Like if somebody told you in 2005 that we were headed to a 2009, but the recession didn't really happen until 2007. Wouldn't you just be happy to know, just to know? And so maybe the recession's not coming right now. Maybe they're going to postpone it for another year. But how nice to sort of have that time to reposition things and to learn and to look at your different options, right?
Yeah, it's probably a pretty good time to get liquid.
Yep.
Now, for one thing, maybe something that's a little bit easier to predict is this behavior. It's kind of a popular notion that the low yields we've had for years on savings accounts, CDs, money market funds, they kind of force a number of savers to become investors. Okay, and those would-be savers end up pouring money into things like stocks and housing. How do you see it? Do you see it as that makes stocks and housing more bubbly because that happens? Or do you think that increases longer-term demand and makes those asset prices sustainably higher?
When people are cashing out or?
Yeah, when people don't get any yield in savings accounts, so they feel like they're compelled or forced to become investors in either housing or stocks just to get some yield that beats inflation.
I think we're going to see that in the coming year or two as people realize the stock market is unsteady. As they start, we've got corporate earnings coming out now, and it's so crazy how these corporations cook the books, and they still don't look very good. I mean, still these companies are way overvalued, and they've done everything they can. I mean, these companies have borrowed this cheap money, this free money, to buy their own stock back. That's like that's like borrowing money to buy your house for $100,000 more to make it look like it's worth more. I mean, it's just that's what they're doing. And so we're going to see that. It's really hard to understand how bad the manipulation is, but it's pretty bad. So as people pour their money out of the stock market, they will be looking for a place for it. And it could go into real estate again, like it did in the early 2000s. And that could drive a bubble in real estate. But as far as CDs, those are people that just want safety. They would be in the stock market if they wanted to play, if they wanted to make a return. They just want to not lose. But unfortunately, they're not really that safe there either, So with deflation, I know a lot of investors are just cashing out. But, I've heard some reports about even concerns about that. In my opinion, the best place to have your money is in a hard asset that's not going to disappear overnight, that has use. Like you said, you're investing in coffee fields. People like coffee. I think chocolate fields and alcohol. My great grandparents invested, they had the speakeasies, right? Because when you have a Great Depression, people like to drink alcohol. So there's always a way to make money no matter what market you're in.
It's pretty recession-resistant stuff, you've got to admit.
But the same goes for housing. I mean, people need to live somewhere. So if you're going to invest in real estate, make sure it's in a recession-proof area. And one of the ways that you can learn that, I mean, besides we give that information away every single week on different markets that are recession-proof, but one simple way to look at it is, how'd they do in the last one? There's a lot of markets in the U.S. that weren't that affected by the Great Recession and by this huge credit meltdown, while other areas just got hammered, and it happens over and over again. We got the roller coaster states and we got the linear states. I'm in a roller coaster state. So California goes up way high and it goes down, and people seem to forget that. But we keep telling people, even now, especially in California, hey, time to exit. We are at a high. We are above 2006 levels. We know 2006 was a bubble. Why would it not be a bubble today if we're over 2006 levels and salaries haven't increased? Salaries just went up 2.2% last year on average. So this is a time to sell in the high overinflated markets and exchange for markets that don't have those fluctuations. That's what we were telling people in 2006. Get out, sell California and buy in Texas, because Texas was 24% undervalued. You can do that today. And Texas is definitely not undervalued anymore.
Yeah.
It was in 2006. But there are markets where there's job growth, where there's population growth, and where real estate is undervalued. And those are good places to invest.
Yeah, it's certainly potentially a good time to exploit that arbitrage, as it has long been, and move that coastal money into inland markets with something you can control, where it's quite a bit more difficult for your property manager to cook your books as it is for the company that you invest in something securitized and indirect like stocks. So, with that in mind, I mean, where do you see the best opportunities for residential real estate investing in the coming years?
Well, like I said, get out of the high-priced, low cash flow markets, because the only reason you'd be there is hoping that there's going to be future appreciation. Those markets they're done. They're not going up anymore. So what you get is low cash flow and potentially a decline in home prices. That's no fun. So great time to sell and get into markets with the opposite going on. So they have low home prices, but high yields. So high rents, low home prices. We have people at Real Wealth Network that sell one California property and we're able to exchange them tax deferred. And that 1031 exchange may not be around forever. So take advantage while you can. And they exchange a tax deferred for, 10, even 20. I had one woman buy 24 properties from the property she sold in California.
Incredible.
She went from $200 a month cash flow. No kidding. I'm not kidding. To $8,000 from doing that simple transfer. So, wow. Even if half of her properties went vacant, she would still be making more money than she made in California.
Yeah. It's incredible. And all the difference is just knowledge. And it just takes one specific piece of knowledge with the right person to totally turn their life on a dime for the better and still do it in actually probably more conservative fashion than where they had been previously.
Absolutely. So, the key factors we look for are job growth and real job growth, not these service sector jobs. We want to get into areas that are producing something, not just selling something. We, move into a different kind of economy that isn't just based on us buying stuff. We need to start producing. So investing in areas where that's happening, where there's sustainable jobs, high paying jobs, and that attract this millennial population. We also like Florida because Florida never really recovered because it's a judicial state and there's still a lot of distressed inventory and home prices are still half of what they were in some areas. Some areas of Florida are way overpriced, definitely the south part of Florida, but Central is still really good. And in that market, we're not so worried about job growth there because we're seeing baby boomers going there. They don't need jobs. They want health care. We follow that. Where is there really strong healthcare where the baby boomers are moving? Because we think that that's going to be an industry that's going to be here for a while. That's not something that you can outsource, right? Healthcare. So we like Cleveland. They have a strong healthcare market. Again, Florida has a strong healthcare market. And then again, areas where the millennials are going. So areas with high-tech companies where their valuations are in line, where they're showing a profit. I mean, in the San Francisco Bay Area, watch out, man, because those tech companies are so overvalued. It's ridiculous. And just with Square IPO'd last couple months ago. I wrote a whole article on this. It had been valued at $6 billion, but has never shown a profit, not once. What? And then when they IPO'd, they couldn't come near that. So right off the bat, it was worth $2 billion less. And then a month or two later, another $2 billion less. Why? Because they were out of their minds. Did you value a company that's losing $500 million a year and value it at $6 billion? Who's doing the math?
Yeah, with PE ratios in the hundreds on several tech companies, it just feels like a lot of speculative froth again.
Absolutely. Yep. San Francisco's going to get hammered. I'm from there. I've watched it go up. I've watched it go down. If you're listening from San Francisco, please. I am a born and raised native Californian. My grandmother grew up in the city. She's all over the San Francisco Chronicle in the 1920s. I know and love that place. I'm going to tell you right now, sell. It's time.
Yep. That sounds straight on to me. Just get into one of those linear markets or pick a couple or three linear markets to get into. Linear markets in the heartland of the U.S., in the Midwest or South that have economic growth and then just enjoy the cash flow ride every month.
I was on a panel at a big conference for hedge funds that have, a lot of these Wall Street hedge funds, as you know, have gone into real estate and single family homes because they're seeing that the rental demand for single family homes is far, far stronger than anything else, than multifamily. Or you're in multifamily and you're an expert there, but there is demand for single family rentals. And so I was on the panel with these folks, and it was really interesting because I had the chance to ask so many questions about how they decide to buy. And listen, they're not all getting it right. Let's face it. A lot of these guys are Wall Street guys that have never managed a single family rental. So they, I'm not going to say that they have all the answers, but I did ask them how they figure things out and how they determine where they're going to buy. And they said they're only looking for cash flow. They don't go to any markets. They have no interest in markets that have capital appreciation because that's not the appetite for Wall Street. And they want to sell, they want to turn these into securities and IPO and all that. So they said only cash flow. It's the only metric they look at. They don't care about the equity in these properties. Isn't that interesting?
That is really interesting. Yeah, I don't know that it was always that way. And you bring up the single family versus multifamily thing. I'm actually glad you brought that up because a few shows ago, I did a show where it was just me on the microphone comparing single family and multifamily. And there's so many pros and cons to each. But in conclusion, I basically posited that single family homes are probably the better place to be for the next few years. And you got a few reasons for that just didn't exist a few years ago. Previously, you were kind of Fannie-Freddie'd out after 10 loans, and now there are more loan programs available for your 11th through 35th single family home. And, additionally, after the mortgage meltdown, you had people that had their owner-occupied homes that lost that home in foreclosure. Well, that home they lost was a single-family home. So if you lost your home and you can't qualify to get another home, you really don't want to go into an apartment, okay? Because you're really downgrading your quality of life, living a more communal lifestyle. So you really want to rent a single-family home. And I think that's just another thing until everything gets cleaned up from the bankruptcies that people had in their life that's going to drive demand for single-family home ahead of multifamilies for a few more years.
Yeah, it's really amazing. I mean, I think you nailed it. They got a chance to live in a nice home and they want to do that. They don't want to go back to apartments, but the millennials don't care. They'll live in apartments, but eventually they'll want single family. Very interesting. The rental growth, the demand that we've seen, it's actually really been spread out where even 55 and up was one of the fastest growing segments of rental growth. And you kind of scratch your head. I don't know why. I always thought that 55 and up, they owned their homes and hopefully had them paid off, but maybe not. Maybe they lost their homes. It was very interesting to see the demand for single family homes in that age range for rental. And then the Gen Xers too. And so, yeah, it's fascinating. Definitely changing times. And man, you got to be on top of it because it changes fast.
It does, and it sure has. And it's been really good hitting on some of these current topics with you, Kathy. Well, how can my listeners find out more about you?
Oh, sure. You can go to realwealthnetwork.com, real like real estate, wealth like your money, and network as in the kind of experts we have all across the country finding our members deals. So realwealthnetwork.com, and you can join for free. That gives you access to a meeting with one of our investment counselors to kind of go over your goals and your portfolio and what markets might be right for you and kind of the pros and cons. And then every Thursday, we do a webinar profiling different parts of the country that we think are booming, that are really good buying opportunities right now for rental property. And then, of course, you can find me on iTunes on The Real Wealth Show and my book, Retire Rich with Rentals, on Amazon.
Okay. Hey, great, Kathy. And again, that's therealwealthnetwork.com. That's where all that begins. Kathy Fettke, thanks so much for coming on to the show today.
Hey, thanks for having me. It was fun.
Hey, I enjoyed that too, Kathy. Are markets too bid up, frothy, or volatile for you? One potentially smart way to diversify is to do what I've done, and you heard their commercial on the show today. That is to diversify into a hard cash flowing asset where there's never any vacancy, it's turnkey managed, and where you own the land, and it's largely uncorrelated with the U.S. stock market and even the U.S. housing market. What I've done is purchased coffee farm parcels 1/2 acre at a time in Panama, secured with a trusted management team who I've personally known for years. That's David Sewell and Darren Doyle at International Coffee Farms. That income stream is generated by the sale of high-grade coffee on your farm parcels. All the selling and everything is done for you such that you just end up with an income check, and it really doesn't even cost that much money to get in. You can learn more about that by getting a great free report at getricheducation.com/coffee. So go over there to getricheducation.com/coffee. You can even use IRA funds to purchase the coffee farm parcels. It does cost you $500 for an IRA setup fee. However, that $500 is waived for Get Rich Education listeners if you use the free report by the end of this month, February 29th. That report again is at getricheducation.com/coffee. I can't officially endorse them or any company, but I'm just relating my experience to you. Next week on the show, we're going to have a deep chat with a popular real estate investing author. That's the Yale University educated Frank Gallinelli. Frank's a professor of real estate investment analysis at the prestigious Columbia University in New York City. Frank is going to make you think about due diligence on income property in ways that you've never thought of before. Special thanks to the terrific Kathy Fettke today. Check out getricheducation.com/coffee before that generous offer ends this month. And don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.